Let's do a little Kudlow 101 because big story in the newspaper today. State pension funds, the large ones, Texas, California, New York, they're moving out of U.S. stocks into foreign equities, dropping their U.S. exposure to as low as 25%. I just want to ask this question. Are you sure, folks? Let's look at some factoids. This is the last 20 years, okay? We're looking at global stocks. Now, the big winner, emerging market stocks, no question. The global spread of capitalism has been fabulous. Look at this return. Just about 20,000% rise since 1987. Okay. Excluding that, however, USA up 481%, Europe up 435%, Japan down 9%. The world, excluding the U.S., 160% on the low side. The total world, 314%. So in other words, after our friends in India and China and Brazil and Eastern Europe and the emerging markets, it's the U.S. that won the sweepstakes. And let's go to the second chart. Here's the big picture story. The Dow Jones, you've seen this before. Look at this move. From the early 80s right up to the present time, it's about 1,200% increase on Dow Jones terms, including dividends, a 14% annual rate of return. I say this because I think, Jeff, that it would be wise for these pension guys to reconsider vacating the U.S. stock market. What is your thought, Jeff Kleintop?
There are great values here in the U.S. Remember, the international markets are value-oriented. They own much more, and they're represented much more by utilities and telecom and energy and financials. In the U.S., we have 3 times as much exposure to technology, a sector I love. We've got double the exposure to healthcare. We look much more growth-oriented than the rest of the world being more value. If we indeed have made this shift from value to growth in the style cycle, now is the time to be thinking about U.S. assets, not foreign assets.
So this could be exactly the wrong time for these big pension guys to do what they're doing, according to this morning's Wall Street Journal.
Yeah, well, exactly right. And take a look at what's happened with the dollar. This huge downdraft has been a big win to the back of investors going overseas. You know, at this point, with this much of a decline in the dollar looking fairly overextended to the downside, is this the right time to reach out overseas? No, I think this is the wrong time. I think you'll see U.S. market outperformance in the next couple of years.
All right, I hope those guys are listening. Let's hit some short issues here. Mark Skousen, we do have a profits problem. I think we'll put it up on the full screen. Now, as yet, it's not an across-the-board profits problem. It's linked to Mr. Schiller's housing deflation. It's financial, subprime, and it's also housing-related, consumers, discretionary. Other than that, though, industrials and tech and others are up year on year. How serious is the profits problem? How important are profits?
Well, it's the most important, one of the most important leading indicators in my judgment. And what's really odd is that in the conference board, 10 leading indicators, corporate profits is not listed. And I found out why. Because it comes out quarterly, and they have a monthly index. I mean, it's the stupidest reason I've ever seen for not having as a leading indicator corporate profits. And
Hang on to that. Hold on to this. There's the big losers. Consumer discretionary, which is tied to the home builders problem and the Lowe's and the Home Depots. Of course, the financials because of these subprime loans. Energy and materials, a little quirky, if you ask me, off very high bases. Let's go back to the ones, the profitable profit sectors. Industrials look fine. Tech looks fine. Household staples, healthcare, telecoms, even utilities look fine, Mark Skousen.
Larry, it's the trend. It's the trend. In other words, if you could show, I don't know if you have a chart showing that corporate profits are, like Bob Schiller was saying, have had 5 fantastic double-digit gains in corporate profits, but it seems to be leveling out, may even start to decline a little bit, and that's the scary part if you want to look for a leading indicator, much better than retail sales, which seems to be what Wall Street is only interested in.
Robert Schiller, you have an ally in Mr. Skousen. He's worried about profits. I think he buys into your story.
You know, profits are not entirely exogenous. A lot of these things are driven by the housing boom that we just saw. When the housing booms, the economy booms, people buy things associated with housing, everything is driven up. And so I think it's an unnatural boom, and it's really unnatural. We've never seen such a boom in profits before. And so you start to worry about, and then you worry about how it affects the psychology of the market when it corrects.
Dolly Lenz, let me come back to you. I'm not going to ask you about sectors of the S&P 500 and profits. I'm not going to do that to you. But I do want to know, for example, as you travel around, What do you hear from the art sales, for example, the art auctions? That's a competing asset class. A lot of well-to-do people will buy art. They'll also buy upper-end apartments. What do you hear from that story?
Well, the last couple of art sales did very well, but as you know, the one prior did terribly, and everybody was quite spooked and scared to death. But I still see all of my clients buying major art, and thankfully they're buying major apartments to put the art on the wall of.
As we all know, Manhattan in particular, and New York City in general, is, of course, the total epicenter of the universe. Total epicenter of the universe.
Total.
We all know that, right. Well put. How's the economy in New York, in your judgment?
The economy in New York is still robust. I think people are just looking at it from a confidence standpoint that maybe it's just a drop less robust than it was. But I think it's still very robust, and I believe will outperform everywhere.
If they didn't read certain newspapers, Dolly, do you think they'd be more confident? I won't name the newspapers because I think we all know them here in New York. If they didn't read certain newspapers, do you think they'd be more optimistic?
Certain newspapers and certain TV channels, yes.
Oh, well put, but not this one, or at least not this program.
And more Broadway plays.
More
we haven't
Broadway.
had any Broadway plays. We've got to have that.
The lights are coming back on, Dolly. Didn't I read that? They're going to reach a settlement on Broadway.
Thank goodness.
That would be great.
Yeah.
We're going to have a great Christmas tourist season. Michael Pansner, let's go back to it. Profits, art, the economy. Where do you come out, buddy?
Well, you know, let's put it this way. I think you're looking at the best of times, and it only gets worse from here. Like I said, it doesn't go in a straight line, but, you know, corporate profits are multi-decade highs relative to GDP. I think it's more than a coincidence that the strength in profits has been linked to this huge buildup of debt over the past 5 years. And as it unwinds, I think the same will happen with profits.
You know, Jeff Kleintop, net wealth has never been higher. It's close to $60 trillion. Stock market wealth is much greater than real estate wealth. I'm one of these guys who believes that the future is always brighter. I worked for a president from California named Reagan who always said the best is yet to come, Jeff. Weigh in. I'm going to give you the last word.
Well, thanks. Absolutely. You know, household net worth is up. It's not pulled back yet. But on this subject of earnings, we can't forget our market history. Remember, in the middle stage of every business cycle, from 96 to 98, from 84 to 86, we saw earnings growth pause, but it reaccelerated again. Those were the best times to buy stocks when earnings growth dropped to flat on a year-over-year basis. Not the worst.
Sometimes looking at, you know, if you're looking down the throat of a recession, sometimes that's the